look, Bitcoin's going to grind up 30 to 60% a year for the next 20 years. Bitcoin is powered by chaos because chaos will never go away. It's always going to devalue all of the traditional physical and financial capital assets. And it's going to be the driver that causes all the smart money in the world to run, to sell their physical and financial assets and to buy a digital asset.
Michael Saylor begins by unpacking what he calls the double reverse logic of macro trading. It's a psychological puzzle that confounds many, particularly when it comes to Bitcoin. Logically, if inflation is high over the long term, Bitcoin should be the #1 asset to own. After all, it's hard capped at 21 million units and inherently resistant to debasement. But paradoxically, in the short term, Bitcoin often drops when inflation prints come in hot. Why? Because traders interpret high inflation as a signal for rising interest rates. That leads to liquidity being sucked out of the system, triggering asset sell-offs, Bitcoin included.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I think there's a lot of double reverse logic that takes place in the macro trading environment. Like, for example, if you knew there was lots of inflation over the long term, the #1 thing to hold is Bitcoin. But when people print a big inflation number, Bitcoin will trade down in the short term. But the double reverse logic is inflation is high, therefore the interest rates are going up, therefore money is getting slurped out, therefore I should find something to sell, so I'll sell Bitcoin. And that's why I would say there are basically two ways to think about Bitcoin. Actually, there's three views. There's the trader, there's the investor, and there's the maximalist. Okay, the trader says it's an asset, I can get a handle on it, I can 50x lever it long and short. They're obsessing over whether or not good news is coming because good news is bad news and bad news is good news, right? And then they want to make sure they're the first one to get the bad news so they can treat it as good news so they can get out of the trade before the bad news manifests or something like that. And if you're one of those traders, you know who you are and more power to you. I'm not that guy. Then the investor view is, this is the dominant digital monetary network in the world. It's going to go up by a factor of 10 to 100. And I'm just going to hold it like Apple, like Facebook, like Google, like Microsoft. I'm going to hold it like my big tech monopoly for the next decade. And it's going to jerk around a bit, and I'm going to buy it on dips. The maximalist view is, this is property rights for 8 billion people. This is the greatest opportunity of the 21st century. This is economic empowerment for every business, every country, every family, every individual, right? I'm going to support it at all times, every way I can, forever, okay? And so you're talking to a maximalist here. I'm beyond the investor. It's not my skin is in the game. I'm beyond that. My soul is in the game. But I think that Thomas Lee, he's done some good work, and he says that Bitcoin generates all of its gains in like 10 days a year.
Fundstrat Thomas Lee.
Fundstrat Thomas Lee. And that just means that, somewhere like 98, 97% of the time, nothing is happening and you're waiting for something to happen. And I would say every macro theory about if the bad thing happens, that's good, and if the good thing happens, that's bad, and if enough bad things happen, that's really good, because then a bad thing will happen, which will be good for us in the midterm. I get it, it's all true, but I just don't choose to play the game. My view of this is that's a game for professionals, and Howard Marks, he says the problem with all these day traders is the stock goes from 10 to 11, and the guy bought it at 10 and sold at 11, and then it goes from 22 to 23, and he bought it at 22 and sold it at 23, and then it goes from 33 to 32, and he shorted it at 33, and he brags that he made $3. But the problem with the whole thing is if he just bought it at 10, he would have made like 10x that much money with no stress, no anxiety, and no risk. And so I tend to think, look, Bitcoin's going to grind up 30 to 60% a year for the next 20 years. And my long-term risk cost of capital is like 29% for 20 years. That being the case, rather than try to time the market, it seems to me like a better idea would be go mortgage your house for 30 years at 3% interest or 6% interest, and then make an investment for 30 years that where you have 6% cost of capital and get 30% return on the capital, and you're getting 24% boost. So I think it's much better to figure out how you raise capital and lever the trade, or how you build a business that actually cashes in on that volatility instead of being the day trader trying to guess the volatility, because it just seems like, you know, it's a fool's errand for the average person. The creation of wars, the cessation of wars, the possibility of tariffs, the possibility of no tariffs, all of these things create anxiety. They devalue assets. And, you know, chaos is just a manifestation of entropy. And the whole, you know, when I was at MIT, you know, we had this tongue-in-cheek joke about thermodynamics. We said, here are the 3 laws of thermodynamics. You can't win, you can't break even, and you can't get out of the game. That's the 3 laws of thermodynamics. And that describes entropy. It's like bad stuff's happening. Your warehouse is rusting. You know, the highways got blockage. There, you know, the plane crashed. A storm hit. I have the perfect business, and then there's a hurricane, and I have to cancel the conference. Okay, so when will that end? That will never end. But what if I could actually get out of the game? Right? Well, what if I actually could create a business where, here's a business where there are no fires, there are no wars, there are no tariffs, there's no product obsolescence, there are no competitors, right? There's no property tax, there's no rent control, there's no expropriation. What if I had a business that was not facing all those risks? And that's what pure digital capital is. That's what Bitcoin is. But now, what if I posit this? What if I said all the money in the world is facing all that risk, and here's an escape from all that risk, and the only reason they haven't bought it is they didn't know about it, or they didn't have a channel to swap the risky thing for the riskless thing. So Bitcoin is powered by chaos, because chaos will never go away. It's always going to devalue all of the traditional physical and financial capital assets, and it's going to be the driver that causes all the smart money in the world to run, to sell their physical and financial assets and to buy a digital asset. And so really, as the world gets educated and as regulators create on-ramps, right? When your bank handles Bitcoin, when a big tech company can wire $1 billion to the bank every week and buy Bitcoin, they'll just be wiring $1 billion and swapping it out because it's easy and it's rational. So that's really what you're looking at, and that's why I think it's just a very elegant and beautiful asset.
The more unpredictable the world becomes, the more people seek a store of value that is uncorrelated, decentralized, and incorruptible. As capital begins to understand this, and as regulatory clarity and infrastructure improve, capital will naturally flow toward Bitcoin. Whether it's a big tech firm wiring $1 billion a week, or retail investors moving from gold and real estate, this transition is inevitable once the friction to entry is removed. When your bank can offer Bitcoin custody, when tax laws are clarified, When institutions can participate without fear of legal ambiguity, that's when the floodgates open.
Bitcoin is every macro trader's favorite asset because they can trade it 24/7, 365. They can trade it anywhere in the world. They can trade it with any amount of leverage, and they can cross-collateralize it with any other asset. And they can talk about it with legal impunity because it's a commodity. It's not a security. And so that makes it the most attractive of all assets to trade on a trend. If you think there's a missile attack coming, you want to sell it. If you think the missile attack was overblown and there's not going to be a war, you want to buy it. I think when people are panicking, they tend to want to do a leverage short on Bitcoin. When interest rates and when the perception is we're going to a risk-on environment or a looser money environment, they'll turn the other way. So I do think that interest rates coming in or the expectation of interest rates coming in is very bullish for the asset. And there'll be certain points where you'll probably see it rip up because of that. I think that this is a pro-business, deregulation, low regulation, pro-business, low tax, pro-innovation administration, in general and everything they're doing. All of those things will be good for Bitcoin over time. I think deregulation is very good, and I think low interest rates are very good.
Saylor ends by acknowledging Bitcoin's unique position. It's beloved by traders because it's open 24/7, 365, highly liquid, and globally accessible. It's cross-collateralizable, legally tradable as a commodity, and entirely borderless. But while traders love the volatility, Saylor urges the average person to avoid trying to game the system. Instead of trying to guess interest rate pivots or geopolitical risk events, he argues, just own the asset. Especially now, with a pro-business, low-regulation, pro-innovation administration in place, all of the tailwinds, from deregulation to lower rates, support Bitcoin's long-term trajectory. Please like and subscribe.